Last month, Congress approved the most sweeping U.S. tax overhaul since 1986. The Tax Cuts and Jobs Act of 2017 was signed by President Trump on Friday, December 22nd. The bill features changes that are intended to spur economic activity through a reduction in both individual and corporate tax rates and by eliminating or trimming a variety of deductions and exemptions to simplify the code. In summary, individuals will receive 77% of the cuts in this package, or $1.15 trillion in cuts. Corporations will receive 23% of the cuts, or $330 billion in cuts. Individual rates are subject to a sunset provision due to what's called the Byrd Rule, named after the late Senator Robert Byrd of West Virginia. It's anticipated, though, that these rates will eventually be made permanent. Today I'll cover some of the changes to the new law that affect most individuals. If you need more detail, I've included references at the end of the presentation. We'll cover these topics: the new brackets, changes to capital gains taxation, changes to the standard deduction and exemptions, changes to the child tax credit, itemized deductions, education plan changes, and also Roth conversions. Now, the new law keeps 7 brackets, but reduces the rate for each bracket. There's a reduction in the marginal rates for nearly all taxpayers. The largest relative cuts are in the middle brackets. Those in the former 15% bracket have been lowered to 12%, a 20% cut in their marginal rate. Those in the former 25% bracket have been lowered to 22%, a 14% cut in their marginal rate, while the top 39.6% bracket has been cut to 37%, a 6% cut in their marginal rate. In addition, 4.2 million households are removed from the income tax rolls in 2018. Under previous law, 43.4% of households wouldn't pay income taxes or would get net refunds in 2018. Under the bill the President just signed, that would rise to 45.8%. Another thing to note is that the marriage penalty has been eliminated in all brackets other than the top bracket. The income levels for each bracket for those filing married jointly are now twice those of single filers. Previously, married joint filers went into higher brackets that significantly more than double the income rates of single filers. Capital gains. Capital gains are still taxed at 0, 15, and 20% rates. These rates kick in at income thresholds rather than being based on brackets. These income thresholds correspond roughly to the bottom of the former 25 and 39.6% brackets at which capital gains were triggered in the previous law. Standard deductions and personal exemptions are now combined into one larger standard deduction. Single filers will have a $12,000 standard deduction. Married joint filers will have a $24,000 standard deduction. Since this new standard deduction is greater than the amount of itemized deductions used by most taxpayers who itemize, this essentially means that most of them will no longer itemize. The child tax credit has been expanded in multiple ways. First, the amount of the credit was doubled from $1,000 per child to $2,000 per child. Up to $1,400 of the credit is refundable. There's a $500 credit for dependents over 17. And the income levels at which the credit phases out have been greatly increased, allowing many more taxpayers to use this credit. The larger standard deduction combined with the expanded child credit will provide a significant tax savings to joint filers with children. Here's an example to explain how. In our example, we use a married couple. They have 2 incomes totaling $150,000, and they have 2 children. So under the previous law, this couple would have taken a $12,700 standard deduction. They would have had 4 personal exemptions totaling $16,200. However, their child tax credits would have been eliminated since their income exceeds the $110,000 or exceeded the $110,000 threshold previously in place. So their total taxable income would have been $121,100. Under the 25% tax rate, their taxable liability would have been $23,257. Now, under the new law, the same couple with $150,000 in income and 2 children would now take a standard deduction of $24,000. That leaves a total taxable income of $126,000. Under the lower 22% tax rate, their tax liability would have been $19,599. Now that couple can in addition take a $2,000 tax credit for each of their children for a total of $4,000. So their total tax after the child tax credit is now $15,599. For this couple, there's a federal tax savings of now $7,658. Now here are some of the changes to itemized deductions that will affect individuals who do itemize. Medical expenses over 7.5% of adjusted gross income are now deductible. That's down from 10% of adjusted gross income previously. Now this is retroactive also to 2017 and it is in effect for 2018. The percentage goes back to 10% after 2018. There's now a maximum $10,000 aggregate deduction for state and local property taxes and either income or sales tax deductions. Interest on mortgage debt of up to $750,000 is deductible. On mortgages incurred prior to December 15th of 2017, interest on debt of up to $1 million is still deductible. Now you may have read or heard that interest on home equity line loans is no longer deductible. However, the law specifies that interest on acquisition indebtedness, which is debt used to acquire, build, or substantially improve your primary residence on a home equity loan, is still deductible. Home equity indebtedness, in other words, indebtedness used for purposes other than improving the primary residence, is not deductible. So if you do itemize and you have a home equity loan, be sure to check with your tax preparer on this provision. Miscellaneous itemized deductions are eliminated. Limits on contributions to charities have been increased to 60% of adjusted gross income versus the previous percentage of 50%. 529 plan distributions can now be used tax-free for elementary and secondary school expenses up to $10,000 per student per year. So where previously 529 distributions could only be used for college expenses, these again can now be used for elementary and secondary school expenses, including in those expenses as homeschooling expenses. And lastly, Roth characterizations will no longer be allowed. Now, with the tax cuts and incentives in the law for both individuals and businesses, and due to the resulting decreased uncertainty in the economy, LPL has upgraded projections for 2018 U.S. economic growth from 2.5% to a range of 2.7% to 3%. LPL is also increasing estimates for earnings and corporate profits for 2018 and has set a target range by year end of 2,850 to 2,900 for the S&P 500 index for an estimated 10% return on equities for the year. Just as important are the potential intermediate and long-term effects of this law. We've talked in previous videos about the fact that both Social Security and Medicare programs will need to be fixed in the next 10 years as the ratio of retirees to workers continues to grow. Some combination of benefit cuts and increases in payroll taxes will have to be considered. If we do that with an economy that has been growing at 3% versus under 2%, those solutions are going to be that much easier to swallow. To me, that's one of the real benefits of this tax law. Now, if you want more detail on the provisions of the law, here are several references to take a look at. Thanks for your time.